We, we have heard a lot on the topic around ESG, which stands for environment, social, and governance. These non-financial factors have been playing an important part of many organizations' strategy towards building a sustainable future. Today, almost 2 years into the pandemic, we are still facing some serious economic challenges, such as high inflation, severe labor shortage, and extreme supply chain disruption. So how do we navigate economic prosperity and sustainability during this challenging time, while continuing this drive of ESG commitment and implementation in an organization? To put it more bluntly, how should we think about ESG or invest in ESG when many businesses are facing unprecedented challenges? Is lending readily available for our sector? Our speakers today from three financial institutions will share their perspectives on this topic. This webinar is being recorded, and CPMA members will be able to view it on the members area of the CPMA website at community.cpma.ca. Before I introduce the first presenter, we would like to thank the sponsors of today's webinar: Farm Credit Canada, Laurentian Bank, and TD Bank. Our first speaker is Craig Clemmer, Manager and Principal Economist from Farm Credit Canada. Craig's job at FCC is to monitor what's happening in the economy and in agriculture, and to evaluate the risks and opportunities for FCC, their customers, and ag producers. Craig joined FCC in 2009 and has a master's degree in agricultural economics. Craig was drawn to the field of economics because he's fascinated by how economic trends like trade, currency markets, and commodity markets work, and more importantly, how it impacts one's bottom line. Born and raised in Saskatchewan, Craig is happily married with 3 children. Here to you, Craig, and you can share your slide with the group.
Well, thanks a lot for having me, and yeah, it's a pleasure joining you here on the call. I'll just fumble here and share my screen. Hopefully this all works, because I'm sure it's not a good webinar unless somebody doesn't try talking with their mute on. So hopefully everything is still working. Can you see my screen okay? Showing up? Yeah. Okay, perfect. So I guess I'm going to give a quick overview of FCC, talk a little bit about ESGs and kind of what it means, and some opportunities and maybe some curiosities and some uncertainties that are really coming through with that. So first of all, just a little bit of a different platform here. Who is FCC? And I guess the one thing about FCC, we are 100% dedicated to agriculture. We were established in 1959. We have a portfolio of over $41 billion, and we have about 97 offices across Canada. We've been continually growing, and that's kind of been our success. But we're 100% invested in agriculture and food. So when we talk about ESGs and we talk about sustainability, food companies and the food supply chain is really being targeted in this conversation right now, because the pressures aren't just coming from regulatory bodies. It's coming from the consumer. It's coming from the companies that have direct access to those consumers, and it's coming to us from a number of different angles for the sector. Why work with FCC? We are a specialized lender in terms of connections and flexibilities. We want to partner with you to understand your business and work with you. So that's a big part of what we're trying to do. And when we talk about ESGs here, we're learning along the way with you as well, because what that looks like is going to be different for every one of us and every company, and that you're going to have different approaches to it. At the end of the day, when we talk about what ESGs are, it's not this nice frilly thing that people talk about. It's actual a financial reporting side of things, and that's something that we need to be adapting to. It's a mindset. It's it's not just talking about what your company's doing, but it's actually reporting those impacts that it's having to the environment. And there's getting to be more and more regulations that are part of that. So we want to be working with you in terms of investing in that and partnering with you on these types of projects. Also, kind of a little bit about who we are and what do we finance at a high level. We're across the whole, it's the value chain, the whole supply chain when it comes to food, agriculture, and ag business. So whether it's food manufacturing, grains and oilseed processing, frozen fruits, and vegetables, wineries, across the whole board, packaging, distribution, we're here for agriculture and food specifically. So when we talk about the produce sector, whether it's the production of produce on the farm, whether it's the processing and putting it into packaging and moving it across the country, or it's the input suppliers that are so important to your business as well. We're willing to work and want to be financing that business with you and finding those opportunities. And what do we do specifically? Real property, equipment and inventory, expansion and construction, startups and diversity. So if there's new ideas, we're here to try to find the right solution and those right opportunities for your business and for your company. So that kind of brings us, I know we're short on time and we don't have a long time to talk about. And I know I got two another amazing speakers here to bring it, and really look forward to the questions that we have. But what do we mean when we talk about sustainability, and what does that mean for FCC? Well, first of all, as I've kind of mentioned, FCC is totally committed to supporting Canadian agriculture and food in the development of sustainable practices. Regardless of the sector, there's a need to operate with environmental innovation being top of mind. And, if we want to be sustainable, that means being in business for the long term. So when we think about what this means, it's about taking on and seeing those opportunities and what that means for your business. Adoption of sustainability practice is going to look very different depending on the sector that you're in, as well as the portion of the value chain within the sector that you're looking at. So, when you're starting to talk about what does sustainability mean for your operation, it's going to be a number of different things in a number of different places. So, I'm not going to come here and tell you that we have all the solutions for you, but we're willing to understand and look at your business to try and find those opportunities and try to tailor that support so we can be a part of that growth and those opportunities. I know for FCC and all financial institutions, we're going to have to do more specifically to ESG and the reporting of ESGs and shift that mindset in reporting. And as was mentioned at the beginning, David was talking about how it's been evolving and it's been on the minds of businesses for a few years right now, but things are coming into play. Specific to FCC, we are a Crown corporation, and the federal government has required us to start reporting on climate related financial risk that's in there. So when we think about what's happening right now and the trends that are moving, we need to continue to push that needle forward and see some of those opportunities and invest in those opportunities. As I mentioned right at the beginning, it's not just coming from the regulatory side of things, but we're actually getting pressures from other parts of the economy, whether it's investment funds looking to make investments in more sustainable environmental type of industries. They're shifting that mindset, and we've seen many organizations say they're not going to be financing oil industries and oil refineries, and there's been pushback at that level. So we need to see those opportunities and how we can be part of that story of change and that part of that story of opportunities. We're also seeing companies like Loblaws and Walmart and Costco trying to reduce their environmental footprint. And part of that is, putting pressure on the supply chains, which unfortunately means continuing to move those pressures further down the supply chains as people are looking to gain that opportunity. And that's really going to start resting on you. And there's going to be that pressure from those areas. So when we're looking at the sustainability, part of the story is what is the risk that's coming about? And what's the risk in terms of your opportunity, your company, and how do you fit into that? Are you going to feel that pressure and start shifting away from market access opportunities because you haven't adopted those pressures? So we need to look at those risks and the opportunities that come about there in terms of how those things are shifting. I guess what I would say from our perspective, we have a mandate to support agriculture and food. That's who we are, and that's what FCC is here for as a Crown corporation. So we're going to be there with you. With your business and try and help that growth and really look for some of those opportunities there. So we want to learn with you, with ESG and what it means for sustainability. It's kind of like learning to swim. You can't just, read a manual and figure out how to swim. It's an ongoing and evolving process, and there's no clear direction. So we want to partner with you and work with you to try and find those opportunities. And, that's going to probably be a theme for a lot of companies and organizations. Just kind of ending quickly, and I really look forward to the questions here. How we're going to help this and how we're going to help you, or how we can help your company is, one of the things that we have is knowledge. And when it comes to food and that, we're trying to push the envelope more in that and support the industry and growth. And one of the big things that we've been putting out and that came new last year was our food and beverage report. And, we're going to be investigating these opportunities. We're going to start looking at those growth opportunities within the industry, kind of reporting in terms of some of the challenges and looking at those industry profitability indexes and try to give an idea of where we see the health of the industry is and just kind of set that up for conversations and stories in terms of how you might be able to plan your business. So I will say from that, I'm showing the picture of our 2021 report. We will be putting out the 2022 report at the end of March. So something to look forward to. So with that, I know it was very quick and condensed here. I'll stop sharing my screen and pass it to the next speaker. But as I mentioned, looking forward to the questions that are top of mind for you and those opportunities and how we can support your business.
Thank you, Craig. I really appreciate your sharing and insights. Yeah, we will go to the Q&A at the end of all the presentations. So if you have a questions, you can send it through the chat box or the Q&A box. I'm not sure if you're able to access either one. So I will be monitoring that at the end and facilitate the questions when all the speakers are finished with presenting. So I'd like to introduce you to our second speaker, Roland Byrne, Vice President of LBC Capital, division of Laurentian Bank. Roland has been involved in the equipment financing industry since 2003. He is well-traveled across Canada, having grown up in Newfoundland and Labrador, attended and competed university in Nova Scotia, and has lived in Calgary, Alberta with his wife and 3 children since 2015. He attained his CPA, CMA in 2011, and currently covers the Western and Atlantic provinces for LBC Capital. I'll turn the mic to Roland, and to you, Roland.
Yeah, thanks so much, Davis, and great job, Craig, on your presentation. So I just want to start by thanking everyone for having me here today. So it's much appreciated. It's very interesting to do these I'm going to say virtual type of conferences. To start, I just wanted to touch based on, I guess, just to give you a bit of background of Laurentian Bank and LBC Capital. So Laurentian Bank, we've actually been around since 1846. We're one of the smaller banks in Canada, but we're actually one of the larger banks on a North American scale. So we're roughly, I think, like plus or minus the 40th largest bank in North America, which is surprising because we're probably, I'm going to say 8th or 9th in Canada. We're traded on the TSX under the ticker LB, and our current market capitalization is around 1.9 billion, just to give you some scale and scope. We're headquartered in Montreal. We have about 2,900 employees, and we're actually, I believe, the only publicly traded Canadian bank with a female CEO, who has been in place for about 1.5 years now. With regards to LBC Capital, so we're the equipment financing division of Laurentian Bank. So our division has been around for about 8 years, and it was a greenfield, I'm going to say, startup within the bank. And initially we started as a smaller sales team within, I'm going to say, Quebec, Ontario, and Atlantic. And we've grown substantially over the last few years, mainly via acquisitions. So in about 5 years ago, we acquired the equipment financing division of CIT Canada, which was a bit of a $1 billion purchase. And we've also acquired a company called North Point Commercial Services, which is inventory financing headquartered out of the US. So again, I mean, and looking forward, I mean, really we're excited about growing our business really by having a customer-centric approach to the way we do business. So that's kind of just some overlap. And Wally, if you just kind of want to, if you can change the slide, it'd be appreciated. Yeah. So that's kind of, again, some background about who we are. When it comes to market coverage, as Davis mentioned, I mean, the area that I manage is Western and Atlantic Canada, and we are truly a pan-Canadian business in the sense that even on my own team, I have a representative in Newfoundland and also a representative in BC. And in between, we have reps across the country. So we truly do service the whole territory well. With regards to what we can provide to the CPMA members, I'm sure we've all heard this saying, don't put all your eggs in one basket. I'm a firm believer that it's really, really important for companies and organizations to have some level of separation between the short-term and long-term lending. And it really just protects, if you want to go back, Wally, but it just puts the company in a better position in the event that there's some challenges within the organization. So it kind of splits the risk amongst the people involved. So again, lender diversification is definitely one thing that we can bring to the table. A secondary piece that I think is very important, especially in a fast-paced environment, is ease of doing business. So when it comes to standard assets, which we would refer to as transportation and construction assets, that's kind of our core portfolio. I mean, we do also offer financing to other products, including some I'm going to say packaging lines, bottle lines, et cetera, like within your own realm. But when it comes to the standardized assets, we have an application-only process that enables us to go up to $500,000 of financing without financial statements. So it's really a very basic approach. You know, what's the background of the business? What are you looking to purchase? Why are you looking to purchase it? And once it's submitted, it's around a 24-hour process. So it's a very helpful, I'm going to say, offering in a quick moving environment. Within our own toolbox, we do offer all the standard loan and lease products, which most financial institutions offer. But we also offer a few niche products, such as an equipment-backed revolver, which is ultimately a long-term revolving facility secured by capital assets, meant to complement the lead bank with companies that have seasonality involved. Because sometimes the operating bank doesn't have the capacity to give the necessary capital that company needs when you're kind of at peaks and troughs within your business cycle. So that's kind of we can also do larger transactions over the $500,000. But when we go to those types of transactions, we do need more disclosure, such as 3 years of financial statements, interims, and a few other things. Hey, well, if you want to move to the next page. So on the ESG side, I mean, my role is again the VP of Sales for the West. So I mean, I can touch on this here, but I'm definitely not as experienced as some other members. The Laurentian Bank did actually just hire an individual that's focused solely on ESG. So it's definitely something at top of mind for our business. One thing it's very unique, and I think Craig actually quasi touched on it during his presentation. So I believe we're the only bank in Canada that has actually came out publicly to the market saying that we're putting the environment ahead of profits, and we're actually not willing to finance any, I'm going to say, projects that involve the exploration and development of oil and gas. We can still, service, I'm going to say, the companies that are working with those organizations. But again, it's a major differentiator for the bank, and it just shows you where the mindset of our executive team is. Like we have made the decision to put the again, environment ahead of profits. Another thing that's more relevant, I'm going to say, to LBC Capital would really be on, I'm going to say, what's happening within the equipment industry. So, I mean, right now we're kind of at the cusp or turning point when it comes to the electrification of vehicles and a bunch of other things. And you know what? It costs a lot of money to actually modernize your fleet. So, you know what, LBC Capital, we will definitely be there to work with our customers and help our customers modernize their fleet with these newer vehicles that have, I'm going to say, less impact on the environment via just, an operating based on electricity. So that's the conclusion of my presentation. And I also look forward to the questions. And thanks again for taking the time to have me. So, Davis, I'll pass it back to you.
Thank you, Roland. Appreciate your thought. And electric trucks, that's first thing come to mind. I'm just trying to imagine with our fleet of 45 trucks that all going to be electric one day or more. So it'll be interesting. I need to talk to all three of you for some
we're getting close.
Yeah, we get some special discount as a panelist. If you get any questions, again, you can put it on the Q&A or chat box, and we'll cover that at the end. Next, I'd like to introduce our third speaker. And while Nicole is putting up her deck, Nicole Vidori, Vice President and Head of Environment at the TVAN Group. Nicole lists TD's environmental strategy aimed at driving positive business results for the bank while increasing the quality of environment. TD's environmental efforts include an ambitious climate action plan with a target of net zero emissions by 2050. Nicole is a proponent of innovative business solutions to support the planet and profits, and has been a key player in the development of TD's signature environmental programs, such as TD's Sustainability Bond Program and TD's $100 billion low carbon economy target. Prior to TD, Nicole was an environmental consultant. She holds an undergraduate degree in chemical engineering, an MBA, and is a professional engineer. She was previously board chair for Not Far From the Tree, a Toronto-based not-for-profit, and has served on the RIA board since 2019. So here to you, Nicole.
Thank you very much, David, and glad to be here. Unlike my other fellow panelists, I am not a banker, but I do work at a bank. My focus is solely on ESG and really making sure that we're positioning the bank well in the face of the different environmental challenges that arise. Just quickly on TD, we have a long history on environment and environmental leadership. We were carbon neutral back in 2010, if you can believe it. No one was talking about climate change at that time or carbon, but we were leaders in that respect. We've been the first to issue a number of green financial instruments to really drive greenhouse gas reductions, including the first green bond from a Canadian bank in 2014. We were the first to announce a financial target to support the low carbon economy. That was in 2017. And what I'd say is most recently, we were the first Canadian bank to commit to net zero emissions by 2050. What we also did is we put out an ESG framework under our TD Ready commitment. And my focus, my role is on environment. My job is to bolster environmental health through our sustainable financial products and services and programs. And we have two focus areas under our ESG framework here: climate change, which everyone's quite familiar with, but also responsible resource use. And I have to tell you, we haven't done a lot on responsible resource use yet. Our focus has been purely on climate change. But this year we plan to take a focus on RRU, as I call it. Climate change, we launched a huge strategy back in 2020, net zero emissions by 2050. And I'm going to focus a lot of my talk today on that and what that means for the bank and for our clients. But then I'll also touch a little bit on responsible resource use at the end and talking about reducing waste. What does that really mean? And promoting principles of the circular economy, which I do think is a huge opportunity for those in the agri-food sector. So aligning to the Paris Agreement in 1.5 degrees Celsius. So we all know that the scientists have come out and they said to avoid the worst impacts of climate change, we need to ensure that global warming does not exceed 1.5 degrees Celsius. And they've gone even further to say that in order to limit warming to 1.5 degrees Celsius, we need to ensure that our greenhouse gas emissions are net zero by 2050. So the good news is that we have a pretty prescriptive endpoint that we all should be aiming for. And we know based on the science that if we get to net zero emissions by 2050, we should be the least impacted by global warming. The not so great news is that it's going to take a lot of work to get there, and it's going to require collaboration across all sectors, government, the scientists, academia, banks, investors, insurers. Everyone has to come together and figure this out. Specific to TD, so when we announced net zero emissions goal by 2050, what was different? Because I did mention to you that we were carbon neutral since 2010, but that was only with our scope 1 and scope 2 emissions. So for those of you who are familiar or not familiar, greenhouse gas emissions are broken down into 3 scopes for your organization. Scope 1 and 2 are your direct emissions. So greenhouse gases from heating, if you're fueled by natural gas. Scope 2 is from the electricity that you use. So the electricity is produced down the road at a power plant. There's emissions associated with that megawatt hour. That's attributed to your company. Scope 3 are indirect emissions. So these are emissions that are enabled by your business, either through your upstream supply chain or downstream end use of your product. So for TD, the biggest component of scope 3 emissions is the emissions that we finance. So what we call our financed emissions. So we have to look across all our portfolios, all the clients and all the sectors that we finance and invest in. And we have to attribute a portion of their emissions to us based on the amount of exposure and amount of credit we have to them. So that I have the units there, tons of CO2e, carbon dioxide equivalents per dollar financed. And when we look at the scale of that compared to our scope 1 and scope 2, it's massive. So right away, we've gone from carbon neutral with just our scope 1 and scope 2 operations to, announcing net zero by 2050, inclusive of our financed emissions. So the scope of the challenge just got a whole lot bigger. So what does that mean for a bank? And it's not just TD, the Canadian, the big other 5 banks in Canada have also aligned to net zero by 2050. But what does that mean for us? It means we have to understand, number one, where we are at today. So looking at all our portfolios, all our clients, what do our emissions look like? What are the amount of emissions that our clients emit? And then how much is attributed to us? And then there's these things called pathways to 2050. This one's a straight line. They're not straight lines, but these pathways are produced by credible organizations full of scientists that, that's their job. They run these climate models day after day. And, annually or even more frequently, they come out with pathways to 1.5 degrees or 2 degrees or 4 degrees. So what we're trying to do is find a pathway that aligns to 1.5 degrees. So what's going to get us there? What's the pathway to get us there? And, there's different organizations. The ones that we look at frequently are the ones from the International Energy Agency, as well as the IPCC, the Interpanel Governmental Panel on Climate Change. So once we know where we're at, number one, we have our pathway, then we can start charting our course and putting in interim targets so that we ensure we're tracking towards 2050. So we'll be setting our first set of interim targets for 2030. We'll be releasing those later this year. So it's fine to set a target, but how are you actually going to get there? So what we need to do is look at our portfolios. Number one, we have to increase our low carbon investments. Then we also have to support our clients in the transition to lower greenhouse gases. So we have many clients across many sectors. We'll be focused on the most carbon intensive sectors for now and supporting them in decarbonization efforts. As well, we'll be looking at opportunities that are in areas that are lower carbon and looking to increase financing and investment in those areas. So what the goal is to get to all low carbon by 2050, or the majority by 2050. The remaining, if we do have remaining financed emissions, this is where carbon credits, carbon offsets, carbon removals come into play. So I mentioned that the other Canadian banks were also on board. Last year, TD, along with the others, joined the UN Net Zero Banking Alliance. So this is something that was being introduced by Mark Carney ahead of COP26 last year. So he was going around to financial institutions all across the world to get them to sign up to these alliances for net zero. And TD signed up to the Net Zero Banking Alliance, but there's also an alliance for asset owners, insurers, as well as asset managers. And really, it's a really powerful group because now we have a lot of brains together and we can all figure out how to get to net zero together. So it's a really interesting collaboration, and I'm confident that, we have the right people at the table to figure this out. I have on the right side what the NZBA, the Net Zero Banking Alliance, defines as high emitting sectors. And so what the NZBA requires is that the bank set targets, GHG reduction targets, for each of these high emitting sectors within 3 years of joining. So that's what me and my team are working on right now, is figuring out calculations of GHG reduction targets by 2030. And we're focused on the most carbon intensive sectors for right now. So we can only pick off 2 or 3 at a time, but we will slowly make our way down the list. I do have agriculture, shipping, automotive, and commercial buildings highlighted here. So I was thinking about, this presentation and the group that would be in the audience and where they would fall under in these sectors. And when we're looking at sectors and we're looking at clients, we're actually looking at the activities that they conduct and the amount of emissions that are generated from the activities. So you could be within the agriculture sector or agri-food sector, but your emissions could be more related to shipping because you're more involved in distribution. So you might fall under the shipping sector rather than agriculture. If you're a grower, you're likely under the agriculture sector. So, just because you are under agriculture doesn't mean that you would be considered a high emitting sector. You could be, in marketing, a marketer, or forgive me, I don't know the span of your industry. So you'll have to forgive my lack of knowledge there, but it really depends on your activity and what your business does and the emissions associated with that. And so this is my last slide, or second last slide. I talked about responsible resource use. I do think that depending on where you are within your sector, you might not have a lot of greenhouse gas emissions, so you might not be considered a high emitting sector, or you might, but I do think the biggest opportunity within agri-food is waste reduction and implementing circular economy principles. I think agriculture is one of those sectors that is unique in that you can, in different areas of agriculture, there's the potential for high greenhouse gas emissions through fertilizers, through methane. But there's also a huge opportunity for carbon sequestration. And that could mean revenue opportunities through, taking this carbon sequestration through soil management, land management practices, turning them into carbon credits, and then selling them on the carbon markets to other corporates who need to meet GHG reduction targets. But waste and circular economy, some people ask what the circular economy is. If you look at the diagram in the middle, linear economy is what we typically live in right now, where we take materials from the ground, we make something, and then we waste it, we put it to landfill. The circular economy is about ensuring that we are keeping those materials that we extract and keeping them in play, making sure that they don't go to landfill. This reduces waste, reduces pressure on supply chains, can be huge cost savings. I'm not claiming to be an expert in this space, but I did put a few resources on the right that could be helpful. I am just getting into this aspect myself, so I'm really looking forward to digging deep this year into responsible resource and what it could mean for not only agriculture, but for the other sectors that we have clients in, and seeing how we can help our clients in this transition. And so I think this is one of the panel questions, so I won't go deep here. I might just end it there, actually.
Okay, thank you, Nicole. And so I think I see there are started questions coming up here. We have heard, from slightly different perspective, I would say, more from the lending side of things in the beginning, what financial institutions are able to do for providing financial support to the industry, like from lending to other possible type of leasing and different type of financing arrangements. So I'm sure each one of the financial institutions have different, kind of approach to this type of a conversation. So if you have any questions specific to those institutions, happy to put in a chat group, but we will also be providing the contact so that you can reach out to them individually if you do have some specific questions that you would like to ask, or they might be able to connect you to the right parties within the firm on the question that you might have. At the same time, for high level, especially with I think Nicole's presentation, I learned a lot more about ESG. I mean, we heard a lot about it, but this is probably one of the most comprehensive kind of high level overview of what that means. You know, in terms of for a lot of organizations, really give me a lot of appreciation for big corporations to drive the initiative, because this is something that, as Nicole mentioned, it takes a lot of work or collaborations, and CPMA is definitely also on the path of trying to do our part. And there's a plastic working group that, you know, trying to link all the retailers and distributors and packaging companies together to see how we can explore that and help do our part in the industry. And so here I will start with the chat box and see. And I'm not sure if the panelists, you're also able to see those questions yourself. I think the first question come here is just, there's a question around if farmers from Ghana, whether they have the opportunity to partner with FCC in providing funds for expert for equipment. So Craig, you want to take that?
Yeah, so in terms of our scope in our company, we mostly work with Canadian companies and Canadian operations. So if there's a presence in Canada, there may be some opportunities. It depends on exactly what you're thinking there. But we do not finance individuals in different countries. Our office and our focus is agriculture and food within Canada and companies within the Canadian marketplace.
Okay, all right. Thanks, Craig. And second question is actually from our president of a CPMA, Ron Amir. Open question. Everyone has commented that there's no common roadmap for ESG lending. If a company is starting from point zero, what can you suggest as the focus area that should be considered by a company? The big five focus on emissions as one area. How do we link the social and corporate governance aspect from farm gate to retail? So this is an open one to the panelists. Whoever want to take it first, and we can go through the panelists. Oh, by the way, we do have another support here from TD. Andrea is our senior manager for the ESG strategy. So feel free, Andrea, you're an expert in this field too. If you see any questions that you have some insight or some comments, please join in, and we appreciate you joining us today.
I think I'll start from a TD perspective. So I showed the big ESG framework on one of my first slides. I'm focused on the E, but you know, my team is also focused on the S. And what do we have under S? It's financial and economic inclusion. And there's a lot of intersection between the E and the S. And we're talking a lot this year about the just transition. So we can't just be super focused on climate and greenhouse gas reductions, that we have all these unintended consequences over here from an economic or financial perspective. So we really need to look at the path to net zero from a social lens as well, and making sure that we're incorporating social considerations into every decision that we're making. So it's a tough path, but I think we have the right principles in place to be able to navigate to net zero. And then if you're a client or a company starting from zero, my advice would be to, number one, get a handle on where your major environmental or social impacts could be or are, like both from a negative and positive perspective. So do you have high carbon emissions? Do you provide, what services do you provide to the community? So you're looking at minimizing the negatives as much as you can, and then amplifying the positives as much as you can.
Thank you,
Nicole. Any other comments, Craig?
Yeah, I think Nicole really described it well. And I think, you know, if you're starting out and you're, you know, this is new to you, you know, the big challenge is starting to get a measurable point too. And that becomes a bit of a challenge for everybody. So I totally agree with what Nicole is trying to see where those opportunities are. I would say it's good to partner with, you know, with your community, whether it's with the organization, whether it's some of your peers, and try to figure out what your benchmark is that you're working off of. And then you can understand where are the places that you need to be focusing on. And maybe there's some things within the industry that can give you some guidelines that, what is the focus on? Where are you marketing? How are you going to build off of that success? Because, with this side of things, it becomes part of this, when we talk about ESGs, it's not just like a nice and fluffy thing. It's kind of like talking about financial statements. It's something that is going to be important to be recording on and benchmarking over time and showing that growth and opportunity. So that's one thing that's always kind of hooked me on it, because we talk about sustainability, and sustainability has been a part of the conversation now for probably 10 or 15 years. And it's evolved what it means for an individual company. So I guess from that perspective, it's just getting a handle on and benchmark where you are right now. And then you have something that you can start building off of and identify, where are you doing a great job, and lean into those things. And then where are those opportunities, and take some time to be measured in it and make those investments to make those improvements in your company. Because it's not just you that's looking for that success, because you're going to have partners up and downstream from you. So, TD mentioned, within their reporting of getting to net zero by 2015, you're part of that success. And, when it comes to FCC, you're going to be part of our success too. So, there's this exchange of information between all your partners. And if you're supplying to any of the major grocery stores or restaurants, they're going to be looking for that same communication as well. So ask questions and be curious. And you probably get some great information from those partners up and downstream from where you are, because it is a system approach. It's a Canada approach to getting to those reduced emissions over time.
I think the next question is an interesting one, and I'll open up. If anyone have any insight, or you may know there are some report or projections for this. The comment is the consumer is already paying more. How much are these changes going to cost, let's say, a family of four? Like, I'm actually curious to know, like, have you guys run into any studies or numbers, or what's your view on, just in general, maybe opinion on or comment on this area?
I can start. Or Craig, go ahead.
Well, I guess at the onset, maybe I'd say is in terms of what is this going to cost? Well, if you're talking about the direct financial costs and whether people have done a ton of studies on it, I guess there hasn't been a whole lot that I've seen at this point. That being said, policy and how policy evolves over time, it's going to make a difference. In Canada right now, we already have, carbon, carbon tax, I guess, when we talk about fuel and the cost of things being distributed. So by making these adjustments, by lowering these costs and lowering that overall system, I'm not sure where it's going to net out. So I can't say it's, $2 or $5 or something like that. But there's some challenges there that, as a country, as a bigger community, a global community, and through the United Nations, they are looking to do this. So if we aren't proactive, if we aren't finding those opportunities, it could actually cost you more long-term as we look at these different policies. And then there's the social side of things and the environmental side of things. Like, we are looking to, as a country and as an organization and as a big community, to lower these global emissions, because the consequences of that could be greater beyond what this is. So what does it cost a family? I can't tell you exactly what it's going to be, because it's going to be measuring the reductions that you're going to have by not having to pay higher carbon costs and the taxation through that. And as we get economies of scale and things, it's probably going to bring some of those costs down when we think about compostable packaging, different types of plastics, and compostable plastic, as for example, is going to come down as we continue to innovate and invest in those opportunities as well.
I think that was a great answer, Craig. The only thing I would add to that is, we're looking at the future costs of climate. And if we don't do anything now, we're going to see impacts of climate similar to COVID. And if not like COVID, I'd say even greater than the impacts that we've seen with COVID. So we're really trying to take action now so that we're reducing impacts from climate in the future. It's an investment.
Thank you. Any other comments, Andrea or Roland? Do you have any?
Yeah, I would just. Oh, go ahead.
So on my side, really, I think the other panelists are doing a fantastic job with these questions. I wish we had our ESG representative with us today. I personally have not seen any of those types of reports. In general, some of the other stuff that we've touched on, right? I know even as there's, I'm going to say, federal or provincial taxation policies in place. To give you an example, here in Alberta, there's actually they're building a 16-story greenhouse to have local production. So, when you think about the cost of transportation, the cost of goods, et cetera, I think at some point the general society will kind of create it to a point that it's more efficient. So again, what does that, like, I guess, boil down to cost per family? I think we can all agree it's more. I mean, I'm not able to pinpoint a specific number for that, but yeah, it's I think it's for the better good of society. But yeah, it's obviously we're in an inflationary time right now, which is a bit challenging.
And I was just going to jump off with something that Craig said, which is that, if a grower decides to invest in some electric vehicles instead of the standard trucking that they're using right now, there is a cost to that investment. But then again, commodity prices on the oil side are rising, and you're looking at record oil prices in the next year or two. So that investment on the ESG side might not be so costly when you look at the alternative.
Yeah, no, thank you. I agree. As a user, as a operator, I can definitely see the some of this initiative that there might be a very high initial cost or capital cost or R&D, right? Look at electric vehicles, and it's, who would imagine where it is today, like 10 or 20 years ago? And looking at the future now, I think, some of the stock markets and valuation of certain companies give us a view of what we think that the 10, 20 years, what it may look like, right? So, I think definitely, we see is the immediate cost that may go up, but I think the unintended, maybe savings or some other actually unintended consequences of not doing something, right, could be even more costly down the road. And so it's a complicated topic, but I think that's a great question, just to give us to think more about this topic, what we can do as an organization or as a CPMA. Here's another question that I think is also very interesting. When a jar of pickles arrives from India, for example, how is the sustainability measure? I think it's probably how is the carbon footprint measure, maybe, or sustainability. So I think we got a couple of ESG experts here. Maybe anyone can give us some insight how this is being measured, not to the specific, but just generally. Like I'm sure there's a way of looking at that, right?
Yeah, if you do a comparison between a jar of pickles produced here versus one in India, the biggest difference is the transportation across the ocean to get here. And that's where the largest source of emissions will come from. So from a ESG and specifically an E perspective, the jar of pickles produced here has a much lower footprint than the one produced in India.
I'm going to throw an economic question there, but doesn't it, the efficiency of that production, thing about global trading with more efficient optimum. So where's the crossroad between ESG and then having this more kind of a global view of, balancing, trades and productions and labor and all this? And Craig, like any perspective?
Well, excuse me. I think we're at a really interesting time on that question, to be honest. With the global pandemic that we've had in Canada, the flooding and the infrastructure damage that we've received in British Columbia specifically, and then on top of it, I'm not sure about everybody on the call, but talking to some of our customers in BC, they got packaging floating off in the ocean because some of those containers fell off some boats. The days of just-in-time delivery has been disrupted in a big way. Transportation is not as reliable as it has been pre-pandemic. We have more and more goods and products coming from Asia. So when you talk about India specifically, we have major, a lot of consumer goods in addition to commodities coming over into Canada from around the world. And these delays in an industry like agriculture that is so dependent on getting, the number of people you need at the right time, the crop inputs that you need at the right time, the packaging that you need at the right time to produce the product that your consumers want is more and more important. As a result of that, we're starting to see a bit more investment, or at least a lot more curiosity of reinvesting in North America, where you have less of that exposure to global shipping and moving. So where does it all pan out? I don't know. I don't have a good answer, and it's probably going to depend on the business that you're a part of. But as we got different amounts of automation coming into North America and investments that companies can do that, where we have tight labor supplies, there might be opportunities for automation to backfill that. And we could see more and more manufacturing happen here in North America, Canada, the United States, and Mexico, because we see some of those disruptions. And when you come to this global shipping issue right now, when you look at most of the projections, it doesn't look like it's going to be totally fixed right away. You look at across the whole Western seaboard, whether it's the Port of Vancouver or the Port of Los Angeles, they talk about, well, we need to add another container shipyard I can't remember how often, but just to absorb the influx of products that are coming from Asia. So there's a big challenge there. There's an infrastructure challenge there that needs to be sorted out. And as a result, I think more companies are looking at reinvesting in North America to reduce some of those supply chain challenges. So we got to look at all of this stuff in a big picture. We're not in a bubble. And, I think that was highlighted in some of those UN slides that Nicole was sharing. We can't live in a bubble. We need to think about ESG as one more component of a complex business that you're a part of, and figuring out where those right investments are. You can't do everything at one time. And, you need to take a bit of a measured approach, but it needs to be top of mind if you're looking at the long-term success of your company. And we got a bit of time right now. We're dealing with a whole bunch of challenges right now. High labor costs, packaging costs going up, and, input costs are all coming up. So it might not be the right time to make an investment in it right now, but it is the right time to start planning for that investment. And then how does that happen over time? And when is the most appropriate time for your business?
Well, thank you, Craig. With that, I can't resist to ask this question with three bankers, or three at least financial institutions here, before I pass it to Wally, our education manager. If you had a crystal ball, how many more raises you think that, how many raises, not more, because we haven't had one yet, interest rate from Bank of Canada for this year, kind of just like no one knows. And then also, what do you think at the end of the year, December 31st, 2022, what the prime rate will be? Today is 2.45. And just out of curiosity, for fun, I always like to ask a question that we can actually track and hold people accountable, but you're not anything if it goes up and down, but just curious, like maybe Roland, you want to start?
Sure, Davis. It's a very interesting question. Ironically enough, there was an internal presentation from our chief economist earlier this week, the day before yesterday, so before the rate decision was made. And he was pretty confident that the rates were going to be increased yesterday. And, to everybody's surprise, they were not raised. And I think really from an economics perspective, they were looking at really the inflation that we're seeing right now. And they kind of felt that, hey, the banks have no choice, or the central bank has no choice but to increase rates. Well, there's still a lot of uncertainty out there, and there's a lot of debt out there. So I'm just, my own perspective is that, hey, rates will definitely go up at some point. Where will prime rate be? I'm sure our economists would probably say, probably 1% higher. But is he going to be right? I think there's just so many unknowns and so much uncertainty with regards to the state of the economy.
Okay, I'm writing down 3.45%. And
sure, but hey, okay. Again, there's just a lot of uncertainty because there's a lot of shocks happening at play right now. And I mean, you know what? During COVID, there was a lot of government spending that's being scaled back. So I think really, in my view, I think they're kind of waiting to see, okay, as they scale back these subsidies and all this injection of cash, how will the economy react? So I think that's really the wild card, and that is my response.
We may bring your chief economist back here for another session.
Absolutely.
Okay, Craig, any view from FCC?
Okay, well, if I got to throw my stake out there, market consensus right now is 1.25%. Maybe I'm a bit more pessimistic right now because of some of the uncertainty. Just to be different than market consensus, I'll go with the 1% increase.
1%, okay.
But I will say, with your businesses and your planning, there was quite a bit of expectation that they could have raised rates yesterday. It didn't happen. And I guess one thing, don't be complacent. The Bank of Canada can raise rates more than 25 basis points at a time. So don't just bank on the fact that because they didn't raise rates yesterday, that they might not, at one point throughout the year, they could raise it 25 basis points or 50 basis points as they're trying to control it. So that's something to be cognizant of. The other thing that I'll throw out there, when you're making your investments and you're trying to figure out what the right plan is for your company, don't just look at what the Bank of Canada is doing. You probably missed your opportunities. But if you start looking at the longer term yield curves, what I find really interesting right now, we're looking at some fairly fast acceleration of interest rates through this year and next year, trying to get down to that long-term average rate of around 2.2, 2.5% by sometime in 2024. But that 10-year bond rate that the Bank of Canada is having, it's starting to flatten out quite a bit. So although we're seeing these rate increases, those longer term money is still cheaper. So keep that in consideration when you're pricing out your products, and work with whoever financial institution you're working with. But talk about some of those money and what terms and lengths you're looking for, because there could be different opportunities, and don't just wait for the Bank of Canada to make its move before you make your decision.
Thanks, Greg. And TD, any thoughts? So do you want to share your comment at all on this one?
I defer to Andrea on this.
This is the Andrea Rudnick personal view, not the TD Bank. I mean, I don't know, after the failure to move the other day, I might go a little bit more conservative and say 75 basis points, but I absolutely agree with what Craig said, which is that running a business in a conservative fashion and a lot of sensitivity modeling to prepare oneself, to prepare the enterprise for rate increases. Just like the oil companies, they do their financial models at $64 oil or 68, but they're not modeling at $100 oil and 87 like it is now. So prepare for a negative situation, and you'll thrive by planning appropriately.
Thank you so much, panelists. Really appreciate sharing with us, and really thank you for your time and insight, and thank you everyone for participating. And I'll just turn it quickly to Wally Byrne, our education manager, to introduce our next webinar in February. Wally, if you want to come in and share your screen for our next session.
Hello, everyone. Just wanted to thank everybody again for presenting today. And I do want to take a minute to let you know that we will have another very interesting and insightful webinar coming up on Thursday, February 17th. It will feature David Guthrie from KPMG, who will give a presentation on the future of agriculture and food. Registration details will be in the CPMA Produce Now bulletin early next week. Once again, thank you very much for joining us, and have a great day.
All right, thank you. I think that wraps it up. And Wally, maybe just if the participants are gone, maybe we just share a minute or two for debrief.